Hey, welcome everybody. It's wonderful to have you all here for our very first Mesh Pro Club Thought Leader webinar. My name is Louise Mazinta. I'm the Chief Growth Officer at Mesh Trade. And I'm absolutely thrilled to be moderating today's discussion on one of the world's most enduring and valuable asset classes, and that's gold. The gold, as you know, has stood the test of time as a store of value, a hedge against inflation, and a safe haven during economic uncertainty. So why are we focusing on this for our webinar today? Well, just in terms of some context, we at Mesh Trade have successfully tokenized a range of other financial asset classes like corporate bonds, equities, funds. And now Mesh has turned its focus to commodities. We've tokenized and fractionalized physical gold Kruger-Rand coins in a way that has never been done before. At 9 o'clock tomorrow morning, we open a 2-week book build for tokenized bullion Kruger-Rand coins at the best retail price in the market. We have a 2-week subscription window, which lets registered Mesh investors subscribe to buy Kruger-Rands at a discount of up to 3% below the prevailing retail price on the date of settlement, which is the 27th of March. So those of you who are gold investors know that this is actually a really special discount that our issuer Troy Gold has negotiated for Mesh investors. It's a price you're unlikely to see in the market again anytime soon. One of the unique features of this offering is that you can buy a whole Kruger-Rand coin or any coin, depending on your investment appetite. And the minimum investment for a Kruger-Rand fraction is just 50 Rand. So it's really important to note that you're not just buying exposure to gold through an ETF, you're actually investing in the real thing, a real serialized and audited gold Kruger-Rand that is securely vaulted at Brinks, insured by Lloyd's of London, fully redeemable via Troy Gold delivering the coin to your home, and fully tradable at any fraction through Mesh's secondary market. So that's just a little bit of context. So enough of me. Connie and Rob will be very happy to answer your questions about this issuance during our Q&A session a bit later. So let's step back for a moment and look at the asset class itself. Why gold? What role should gold play in an investor's portfolio? And what are the macroeconomic forces driving its price to all-time highs? To help us unpack all of this, I'm absolutely delighted to introduce today's esteemed guest speaker, and that is Mohammed Nalla. Mo is a globally recognized macroeconomic strategist and the co-founder of Macro Tech Research, where he advises institutional investors, asset managers, and many multinational corporations. He's had many previous roles as head of macroeconomic research at the PIC. We managed over $200 billion in assets, and head of global markets and treasury research at Nedbank. So he brings us enormous expertise in global macro trends, emerging markets, and investment strategy. And you might also have seen him on TV. He's been on CNN, Bloomberg, CNBC, and lots of other leading financial platforms. So today, Mo's going to take us through his expert view on gold as an investment class. He's going to look at both the historical context and the current macroeconomic landscape, so helping you understand why now is such a pivotal moment for gold investors. After Mo's presentation, we'll open the floor for an interactive Q&A session. And he'll be joined by our 2 Mesh executives also on the screen before you, Connie Bloom, who is the co-founder and managing director of Mesh. And Connie's expertise lies in both financial engineering and capital markets and very sophisticated mathematical models. And she's really been the driving force in building Mesh's next generation investment infrastructure. And then Rob Mackay, our investor manager lead, he's a seasoned wealth management professional with nearly 2 decades of experience in private wealth, investment advisory, and alternative asset structuring. So as you listen to today's session, I really do encourage you to think about any questions you may have for Mohammed, Connie, and Rob, and just please drop them into the chat window as we go. Ideally, indicate who on the panel you'd like to direct your question to, and we'll bring in as many of your questions as we can in the discussion during the Q&A session. So without further ado from me, please join me in a warm welcome to Mohammed Nalla. Mo, over to you.
Thank you so much, Louisa. Wow. I mean, that's quite the intro, and I'm honored to be invited to do this with yourself, obviously, Connie, Rob, and the Mesh team. So I think without further ado, it's such an important topic. Gold is such a large topic at this point in time, and there's going to be a lot for us to get into. So I prepared a bit of a presentation. We're going to reserve the Q&A for our guests at the end of the presentation, just so that we can get through a lot of the content. We may cover some of the stuff as we go along, and that might address some of the questions that you have. And hopefully we get a couple of questions that maybe we haven't touched on, because like I say, gold is such a wide-ranging topic that it's really impossible to cover the full breadth of, what are some of the dynamics within just a 1-hour presentation. Firstly, just a little bit about me. I think Louisa's gone through that, so I'm not going to spend much time on this particular slide. That's just about myself and Macro Tech, some of my partners there. The structure of our presentation will start off with the history of gold. I think that's very important to contextualize just the place that gold holds in investors' psyche, in humanity's psyche, quite frankly. We'll start off there. We'll then move into a view of the intrinsic value of gold, then some of these psychological reasons, and maybe even just financial reasons of why do investors turn to gold, a look of gold in the modern portfolios, some recent trends, and then we'll wrap that up with an investment case. Firstly, with the history of gold, that's a nice ancient Roman coin. And I know some people like to see gold, and that's part of the discussion we're going to be having here. So you'll see lots of interesting graphics throughout this presentation. But I spent a lot of time on this slide, and the reason for it is because gold is really this timeless asset. It's this timeless asset that if you go back to ancient times, there's a picture there of the Egyptian pharaohs being buried with their gold. And that's because gold embodied this perception of value for the longest time. It also embodied, all of the critical elements of being a medium of exchange, in that it is durable, it is fungible, it is something that can be denominated in smaller quantities, and it's easy to exchange. And those are all of the elements of effectively what one would look for when looking for a sound money principle. That's why gold was effectively the currency of choice alongside silver all the way back then. Then around 560 BC was actually when we had our first standardized gold coin. And it was around 10 grams. It was called a Croesus. Some of you who enjoy history will know a historical figure called Croesus, who was famous for his wealth. And that's a picture of what the Croesus actually looked like. It's got a lion that's attacking a bull. I don't know if that's any reference to the kind of bull market that we're seeing in gold at the moment, but I found that interesting. And if we fast forward to Roman times, and the reason I raise this is that it's so important in the context of what we've seen globally between the 1970s and today. And let me unpack that for you, is that the Roman currency at the time was called the aureus, referencing the gold coin specifically. And what had happened is, as Rome's wars became increasingly expensive, they needed more currency or more gold than they had. And what they did is they started to debase the quality of the coins that are actually put out there. And as a result, over the time, the value of that aureus was actually reduced because they were just putting less gold in there. There were more impurities. And this caused inflation and economic instability that then severely weakened Rome's entire monetary system. And many historians say that was actually part of the reason why Rome eventually fell. Now, the reason I raise that is a lot of you are going to see the similarities, the analogs to certain events that we're seeing in the world today, and we can unpack some of that. Let's fast forward and go very quickly now. 1684, that's when the Bank of England was formed. They backed their currency with gold. In 1870, other major economies, including the US and Germany, moved over to the gold standard. And then, unfortunately, early 1900s, all the way to the mid-1900s, I guess, World War I, and then subsequently World War II. But World War I predominantly led to many of those countries abandoning the gold standard because they had these war-related expenses. Again, look at the analog between Rome, what happened there. It was war that was very expensive. Same thing happened in World War I. Countries had to move off the gold standard because they had to pay war expenses. and they didn't have gold that was actually what was backing their currencies. That's really, I guess, where we saw fiat monetary systems start to come through. Now, it's not quite there yet, because in 1944, the world signed the Bretton Woods Agreement. Some of you will have heard this term. And this was really where global currencies were then tied to the US dollar. So now you're starting to see the rise of the US dollar as the global reserve currency. And what's important to note is back then, the US dollar was still backed by gold. And that gold was valued at around $35 an ounce. Incidentally, that was more or less the value of gold at the time. So you could see that as effectively a one-to-one backing, the US dollar just saying, you can use our dollars, it makes it a lot easier. You don't have to have the gold. As long as you kind of back it with US dollars, you're fine. Now, fast forward, and you can see how this raises all kinds of distortions in the market. It's the exorbitant privilege that the United States has enjoyed over the world for the longest time. And in 1971, President Nixon, very famous US president, he ended the gold standard. He severed that link between gold and the US dollar. And this led to what we now know as the modern fiat monetary or fiat currency system. Now, that's come with a lot of problems. There's inflation. We'll show you some interesting charts there. But then now let's look at what's happened to gold more recently. Global financial crisis in 2008, which to some of us still seems like yesterday, but it is actually an age ago. And back then, interest in gold was renewed. Gold had gone sideways for such a long period of time. But that global financial crisis reminded investors that actually, even in a modern system, even with the current policies we have, crises can still happen. They can still be devastating. And that actually pushed gold above that $1,000 per ounce mark. And that was, again, psychologically quite a big level. And right now it seems so low because we're close on testing $3,000. It just shows you how quickly the world actually moves. Then in 2011, gold hit a then all-time high at $1,920 per ounce, almost $2,000 an ounce. And again, like I say, it seems in some respects a long time ago, in other respects pretty recent. Subsequent to that, more recently, central banks led by China, Russia, they've been increasing their gold reserves. And we'll unpack some of this as a hedge against the geopolitical risks. I don't have to unpack those for you. We know there are wars with Russia and the Ukraine, there China and the US, or really China-Taiwan tensions. And so that geopolitical risk has actually led some of those Asian central banks to rapidly start accumulating gold reserves. In 2024, gold surpassed $2,000 for the first time. It actually then reaffirmed its role as a hedge against inflation, some of the economic volatility we're seeing. And then this year, with the US actually set to audit Fort Knox, who knows what's going to be coming out of there? A lot of people, conspiracy theorists, saying it's not actually the 8,000 tons that the US says is actually sitting in Fort Knox, but also with the backdrop of US foreign policy and domestic policy that is unprecedented. We haven't seen that. And that lends itself to significant uncertainty, which plays strongly into gold's safe haven demand. Let's go on from that into the look at the intrinsic value of gold. And this is very important because I mentioned 1971. Remember when Nixon actually went off the gold standard and we saw fiat monetary systems come about? That's really when you start to see all of the action materialize on the gold price. And I've got it as 1975 because the house price data in the US doesn't really go back in the same manner before 1975. So it's pretty close. And back then, the average US home cost around $40,000. And if we translate that into how many ounces of gold at that gold price at the time, it was around 220 ounces of gold. Again, you can picture someone walking around with a little bag with little gold coins in there. 220 of those coins, that bought you a house in the US. Back then, if you were earning money, if you're a salaried worker, basically your average wage was only $4.50 an hour. I say only, it gets a lot worse. Oh, that's a little bit of a spoiler there. But it took around 40 hours of work to earn 1 ounce, which means to buy your house, 8,800 hours. Now, fast forwarding to today, the average US hourly wage is $30.84, which is roughly 95 hours of work per ounce. Look at how the value of labor has been degraded in gold terms. And then similarly, if you price a US home, interestingly enough, it's around 171 ounces of gold, but it's still over 16,000 hours of work for a house. And that's, again, just showing you how asset prices, house prices, and wages have moved alongside. It's why I put it here in terms of what is gold worth, is because at the end of the day, we measure our time against a monetary factor, whether that is dollars, whether that is gold. but it's also in terms of what can your money buy you. And house, I mean, that's really something that's quite essential. I thought that was a good analogy. This is a graphic of, again, now going back to 1971, not 1975, how much has US wages actually decreased in gold terms. And what you're looking at there is it's gone all the way from around 0.09 to around 0.01. That 3.9%, that is a compound annual growth rate. That is saying that laborers have gone backwards by roughly 4% every single year, compounded over that time period. That is just staggering, and it tells you that the monetary debasement that you've seen in fiat currencies, people think their wages go up every year. In dollar terms, maybe they do. Maybe they're adjusted for inflation. But when you look at that versus the gold price, versus an intrinsic value, let's say gold is the ultimate long-term store of value, let's assume that. If you look at it in gold terms, you can see labor has gone backwards by 4% every single year since the world moved off the gold standard. But equities, they've been okay, right? Everyone will tell you, oh, buy equities, you hedge yourself. I mean, if you look at that, from 1971, that's actually gone up by around 8% on a compound annual growth rate. This is not a total return chart. We'll get to that shortly. But this is just showing you the share price move. And a lot of this is dependent on this parabolic move that you've seen in the S&P 500 over the course of the last several years. Very much a tech-driven rally, but we'll take it. A gain is a gain, 8%. Equities, they've done okay, right? Maybe not. If we look at the S&P 500 in gold terms, look at that. Pretty much sideways. Yes, it's sometimes, if we had the dot-com boom and bust at that point in time, equities were massively outperforming gold. Gold had gone through this massive sideways consolidation for a long time, and then subsequently gave it all back. And so this really begs the question of, what is actually the store of value? If gold is a store of value, if you see that as a quasi-currency, that correlating with the types of returns you've seen on equities, but equities coming with a lot more risk, and we can unpack that. Now, moving on from that into why investors turn to gold. This chart sums it up, right? I mean, why do you turn to gold? I mentioned it's a store of value. It's got scarcity. I'll show you how scarce that actually looks in terms of the amount of gold above ground versus how much gold is potentially left in the ground. We've got that scarcity and that intrinsic value element that comes through. But the chart you're looking at now is just the economic policy uncertainty index. And you can see this, it kind of bumbles along. We know policy uncertainty, and it's the US specifically. We have these periods where they flash up. You get the dot-com, you got the global financial crisis around the 2008 mark. Then you actually have the COVID pandemic, which caused this massive spike. But outside of complete crisis periods, outside of a global financial crisis, outside of a global pandemic, look at the levels we're seeing on economic policy uncertainty in the US, just emanating from the current Trump administration. I'll give you a good example. Just last week, I sit in Canada at the moment, and we had Donald Trump, obviously, he's threatened Canada and Mexico with tariffs. So on Monday, he had announced that the tariffs were delayed from March to April. On Tuesday, he said, oh no, it's back on, it's coming in March. And by the end of that same week, he actually indicated that he was escalating or increasing the tariffs that they had originally announced. So that degree, 3 policy shifts on trade with effectively your neighbors, big allies, big trading partners within the span of a week is the reason why this economic policy uncertainty has spiked. And again, this contributing because gold benefits in times of safe haven demand, in times of economic policy and just geopolitical uncertainty. Now, why do investors turn to gold when you look at inflation? Gold tends to do well when inflation runs hot. I've got 2 charts here. It's US inflation on the bottom channel. It's gold at the top. And you can see over very specific periods of time, that's where I've annotated it on the chart above, when inflation starts to run really, really hot. And back in the 1970s, we had the oil crisis. We had them moving off the gold standard. All of that coming through here. In those periods, gold doing really well on a compound annual growth rate over those time periods. Then when inflation was tamed following the Volcker years, high interest rates, inflation comes down, stays pretty stable within a range, and so does gold. Over that entire time period, it went sideways. So a lot of this will tie into what is your outlook for inflation? What is your outlook for the fiat monetary system? Are governments like the United States compelled to continue printing dollars to offset their deficits, to actually fund the economic engine and the system that they have built? That really is what this boils down to when you're considering gold versus inflation. Again, full disclaimers, it's on the presentation, it's on here. past performance, no guarantee of what happens in the future. I'm just drawing your attention to what are some of the historical relationships, correlations. We'll get into that. And the next slide is on gold volatility. I mentioned how gold's performance has really been comparative to what you've seen on the S&P 500 in many respects over the long term since the 1970s. But what I've mapped here is just historical volatility. And back in the 1970s, as I indicated, very volatile time for gold, very volatile time globally. You had the oil crisis, you had massive stagflation in the US and globally. And once that came out of it, you actually saw gold's volatility move into this pretty range-bound level. Let's call it between the mid-teens up to around 40 at the higher end. At some points in time, obviously, yes, spiking. Periods of crises, it spikes to around 60. But if you compare that to equity volatilities over the same time period, you'll see that equities exhibit a structurally higher volatility than you find on gold. And so it stands to reason that the risk-adjusted returns of gold have been superior over those measured time periods. Now I'm going to move, I feel like I've been speaking quite a bit. I'm going to move on to gold in modern portfolios, right? And this is important because sometimes people are like, I've got to buy a physical gold coin. It's got to be a Kruger Rand. I've got to actually keep this coin under my mattress or in my couch. I always get teased on this one. But that's not necessarily true. There are many ways that investors can actually access gold. They all have different characteristics. And before we even go there, the first look, I mentioned correlations, right? On correlations, if you look at gold, how it's correlated, and I've borrowed this correlation matrix from Van Eck. They're really good in terms of global gold ETFs. They have funds with regards to global miners and so forth. And so I figured instead of recreating it, let me actually put this on because it was actually quite a good matrix. What you can see here is that if you look at the correlation between US stocks and gold bullion, gold miners, it's actually very low. And this is important because you're looking for an uncorrelated source of return. I think it's important to also note that returns can be comparable, but they can also be non-correlated, which is what you're seeing in this instance, is that gold's actually given you a similar type of return, but usually when gold's running really hot, you're seeing some pressure in equities and vice versa. And this is what you're looking for in terms of just finding a diversified asset within an overall portfolio. It's just good portfolio construction. Non-correlated assets tend to produce better risk-adjusted returns over the longer term. Let's quickly look at, I see Rob has come on, and I think he...
Well, I was just going to, maybe we should, for the audience, because not everyone's technically a fay necessarily with correlation and what it would mean in what I've read from your modern portfolio being a model portfolio, and what it means to have, or how would gold fit into a model portfolio, and what that would mean in terms of that correlation and the risk-adjusted returns.
Rob, thanks for that. I think it's also important for me to catch a breath sometimes. I feel like I'm speaking quite a bit there. You could say modern portfolios, but equally model portfolios. I think your question is very valid. Let's break that down. I mentioned gold's superior diversification properties, the fact that it's a non-correlated asset. And quite typically, when you're looking at model portfolios, not modern portfolios, model portfolios, and specifically in the context of maybe retirement funds or just long-term planning, you typically have what is seen as a 60-40 split. And that would be a 60% allocation to equities, 40% allocation to bonds. And then over time, as you go through your life cycle, you kind of decrease the equity component and you increase the bond component. Now, that's very traditional portfolio construction theory. When you're looking at gold, when you're looking at commodities, these are often seen as alternative assets. A lot of regulation around the world doesn't permit regulated assets or pension funds to hold physical gold, which I must say has actually started to change, but it's actually hindered the progress that portfolio managers, savers, investors, retirees can make in their portfolio. Going to the size of the allocation, again, it varies. There are varying opinions in terms of what's optimal. What I've certainly seen in practice has been starting off at around 5% on the lower end, 10% seen as kind of the ideal allocation to gold. Some people going as high as 20, 30%, just depending on each individual investor's risk tolerance, general aversion to risk. And I think that's where it kind of stacks out. A question I'd like to maybe pose back to you, Rob, is that, I know you've been in the financial services space for a long time. You've been in the private client space. I see in the institutional space, those that are allowed to invest in gold, 10 to 15% seems to be the sweet spot. What are you seeing in the private client space? Is that a kind of number? Are private clients overexposed to gold? Are they underexposed to gold?
So I would answer that simplistically, that they would be underexposed to gold. I think there is a lack of availability or ease of availability to get physical gold into portfolios. And I think the stopgap is then the ETFs. And I know in your slides, you're likely to get into the ETF industry and gold-backed ETFs later. But I would think that they're very underrepresented or undervalued in gold. And I also think it's more a stopgap of the advisors picking a gold miner, which is a higher risk, more very technical, very cyclical pick, as opposed to the physical gold. And then you have the other side of the equation where some of the analysts and or businesses don't have a fully fledged technical resource research team. So then they'll default to what feels like a less risky access point to commodities, and they'll buy the global multinational multi-asset miners and hope that the gold price pulls you through some of the downside of the other assets. But in a long-winded manner, they're in physical gold, they're very underrepresented.
Thanks. I think that's actually great to just understand the context, because it certainly correlates and confirms some of what my suspicions were. I'm a little less exposed to the individual client market than I was back in the day, but I do see a lot in terms of the institutional portfolios. And that underrepresentation for me is maybe, to your point, Rob, a question of access. I think hedge funds, pension funds, they can access gold futures, they can trade in much larger sizes, some of them can access physical gold. Access for retail investors has been something that has been lacking. And again, hopefully something that I think Mesh is addressing with regards to its current offering. Let's get back on track with regards to the presentation, because I wanted to unpack, we are discussing gold's role in a modern portfolio, and as Rob said, maybe a model portfolio. How's gold actually tracked versus other asset classes? And again, with this, I'll go back to, let's call it the early 2000s. Why not 1971? Is, again, you're not going to get the full kind of breadth of history on some of the tickers. They're not directly comparable. And over this time period, I'm not going to say to you, hey, gold was the best performing asset class, because it wasn't. I mean, if you look at the NASDAQ, that shot the lights out. It's currently up over that time period around 1,600%. Gold, half of that. But again, I'm going to stress the risk-adjusted returns. That's an important point to note. I'm also going to point your eye toward the kind of period coming out of the global financial crisis, and even prior to that, where you can see gold had actually outperformed a lot of the equities over that time period. And they were playing catch-up following the global financial crisis. The other important point I want to just highlight on this particular slide has been, I mentioned the S&P 500, but I've also mentioned the S&P 500 total return. Because a lot of investors that say, gold, you don't earn anything from it, there are no cash flows, it's terrible. If you wrap up the cash flows of the S&P 500, again, you simplified this, maybe individual stocks are slightly different, but on the S&P 500, if you actually wrapped up the dividend return on top of that into a total return index, over this time period, gold has actually slightly managed to outperform the S&P 500 total return index. And again, there are periods in time when it outperforms or when it underperforms. So again, that's just showing you gold's role in a portfolio. It's a non-correlated type of return, pretty respectable on a risk-adjusted basis, and shooting the lights out even versus US house prices, and certainly versus the US 20-year Treasury or TLT. That's an ETF. Now, as South Africans, and I know predominantly our audience on this webinar today are South African investors, there's also the element of a currency hedge, because we know South Africans know or generally believe the rand tends to depreciate in a straight line. It doesn't, incidentally, even though this might look like that. So what I've done is I've mapped the rand back from 1971. I like 1971 because, again, we're talking gold, so it's when the world went off the gold standard. And not a lot of people know this. Certainly some of our people who were around in 1971 will realize this, is that the rand actually traded and was stronger than the US dollar back then. And over a period of time, you can actually see how it has drifted weaker. And again, I put the compound annual growth rate on there, 6.2%. that's pretty much tracking in line with inflation, right? It tracks in line with your interest rate differentials. And it's not to say you don't get dislocations. You get massive dislocations around the emerging market debt crisis, around the dot-com boom and bust, around Nenegate, which is still very prominent in many people's minds, then the pandemic. And we've seen the rand kind of consolidate sideways. But if you just put a linear regression on this, you can see those periods where it blows out, it kind of pulls back to mean, blows out. And that's because the economic reality is that your currency will likely track in line with inflation differentials and interest rate differentials. Those change. It means the slope of this line may change over time based on those specific metrics and how they're behaving. So how does gold behave versus the rand? How does gold behave as a South African investor? And this is important. There are two slides I'm going to show you. The second one I actually had to double check. The first one is, this is gold versus the rand. Okay, now it's a cheat because if you look at the top right, you'll say it says mixed. That's because it's the return of gold in US dollar terms over that time period, and it's the rand over that time period. And again, you can see gold slightly superior and around 7,500% over that entire time period, around 8% on a compound annual growth rate. Sounds fantastic. Now, I'm saying let's base this back into rand. If you were a rand investor in gold, what did that look like? I'm going to pause here just for effect and to catch my breath, right? Gold as a currency hedge for South Africans has been phenomenal because you've got to superimpose the currency depreciation on top of the dollar return of gold. And that has translated into roughly a 15% compound annual growth rate in rand terms. That is 183,000%. That's the number I had to check again. I just had to make sure. Yes, it's almost 1,900 times since 1971. So go and pull up a chart on your data service of choice and check that out. It's because you're compounding. You're compounding both the rand as well as the gold return every single year over that time period. And this, again, I think talking towards the gold as a currency hedge, specifically for investors that sit in emerging markets where there are volatile currencies and lots of additional uncertainties. Again, playing to gold's safe haven demand. Let's move a little quicker here because I want to get to some Q&A, some recent trends in the market. First and foremost, some of you will have heard COMEX Gold, effectively the deliveries on those US financial futures, the deliveries, people actually taking physical delivery of gold, that has spiked massively recently. And some people are saying it's because there's no gold in Fort Knox. And so now they're trying to bring all of the gold from Europe across to the US. They're literally doing this. They're flying it across for delivery in the US, in New York. And I'm going to say, okay, maybe there's no gold in Fort Knox and maybe someone's trying to get the gold in there before they do the audit. But it's actually more likely related to the fact that there's currently a pricing arbitrage. When you look at how gold futures trade versus the spot price, there's usually a differential that you would need to assign to the cost of transportation, that's for geographical arbitrage, as well as storage and insurance. And from time to time, those prices move out of sync with one another, and investors decide that actually it might make sense to actually get the physical gold in Europe, fly it across, factor in the transport costs, and then deliver it for physical delivery on the settlement of a futures contract. That's part of the reason, but I'm not going to, let's say, I'm not going to poo-poo the conspiracy theory out there that says maybe there's some dislocations in the physical delivery market in the US, and perhaps that is driving some of this behavior. Now, taking a step actually back and away from that, to understand recent trends in gold, you've got to understand the overall gold value chain. Now, I'm not going to bore you and take you through this entire slide in detail. The slide deck will be made available, and I know this is being recorded. You can go and have a look at it. This is from the World Gold Council, some phenomenal resources on there. For those of you interested in detailed underlying data on gold, go and check them out. But you've got to understand the gold supply market is a product of exploration companies finding reserves, then effectively extracting those reserves. Remember, that can be done profitably or not profitably. I know Rob raised the point around gold miners. We can maybe touch on that. Maybe there's a Q&A coming a little bit later on around gold miners versus bullion. They then mine it, some economically feasible, some not. But that then goes into refiners, gets turned into product, and then those products get used in a number of ways. And actually a large use case for gold is jewelry fabrication. Then there's the actual bar and coin market. We're talking Kruger Rand linked tokens with mesh today. That certainly would fall into that specific segment. Then a lot of people don't know this, but technology, our electronics, they use around 8% of the gold in this value chain. Then central banks taking some of that, and then ETFs and similar products that also coming about in the overall mix. And again, some of this gets recycled back into the original refining factor. That's just the gold value chain in a nutshell. The reason why I raise this is I want to look at the underlying trends. What's been happening with regards to demand from each of those sectors of the value chain? First and foremost, technology demand. Despite what you're seeing, AI, new chips, and the rest, gold demand or demand for gold from the technology sector has actually been pretty stable over the longer term. So that's not really the driving factor. That's not the driving force. If we look at jewelry demand, that's kind of lagged. I think you can correlate that to the poor performances you've seen on some of the luxury goods companies, for example, maybe some changes in China, not so many gold watches. Jewelry demand, that's lagged. So that's not really driving some of the upside impetus. Investment demand, now it's starting to get interesting, right? If you look at investment demand, not fantastic recently, but it has accelerated. It's accelerated a lot off the kind of bases you had seen in around 2023. And again, if you go back to pandemic times, have a look at that. You can see, and again, you're referencing to the left-hand side of this chart, and then this yellow line, that's the gold price referencing the right-hand side. If you look at demand in the pandemic, that uncertainty premium, that's coming through there in terms of demand. We're not at those levels yet, despite the fact that that economic uncertainty index I showed you is kind of pretty much moving to those levels. In fact, if you map investment demand against that economic uncertainty, that makes a very interesting picture as well. And then if we look at ETFs, and this is still linked to this prior slide on investment demand, total ETF holdings of gold, those have actually risen. This has become a lot more important in the market. And currently on this particular chart, it's actually around just under the 100 million ounces level. Sounds big, but it's actually small when compared to central banks. Central banks have been one of the largest drivers of the recent gold market. If you look at this, very resilient, robust from 2022, strong demand coming through. And this is because of the heightened geopolitical risk premium, that safe haven trade really coming through. Very quickly, who holds what? I'm not going to spend a lot of time on this. This purple block, that's supposedly the United States. They're 8,000 tons. We'll find out soon enough. Western Europe, Germany, they're quite large holder. You've got a couple of other European countries coming through. But what I want to highlight here is actually Asia. And it comes through very nicely on the next slide. If you look at total reserves, total FX reserves, China, significant FX reserves, but a lot of those are sitting in US treasuries, ironically. If you look at China's gold reserves, they're a lot lower. The US's gold reserves are higher. And if you map that as a percentage of the total Forex reserves, China sitting at around 6%. Now, why do I highlight this? Is China has actually been a large driver of the buying interest in the gold market. We've had Russia come through as well. And if China were just to move to levels half of where the US are in terms of their total reserves, just given the scale of ammunition the Chinese have in their reserves, that could be a massive driver for gold. Now, the Chinese are smart. I don't believe they go out there and disrupt the gold market. But what we have seen is that they've been steadily allocating money to gold. And we can unpack that very quickly. But in the interest of time, I'm not going to spend too much time on the charts. This is just all central banks together, gross purchases of gold over the course of the last while. But China specifically, look at this chart. From 2022, China has been increasing its gold reserves. Back then, it was just around 3.5%. It's now close to double that. And you can see a steady pace of accumulation on this chart. Then they go sideways as they maybe have some economic realities, structural reforms to enact within China. And then it's looking as though it's starting to escalate again. So this is really an interesting trend. And I would suggest you watch these trends very, very closely. Incidentally, if you look at China's Google equivalent, that's Baidu, and you look at the prevalence of just a generalized search for the word gold, look at the spike that's actually come through from 2023 onward. And remember, this is not the central bank. These are people, you and I, sitting at home, Chinese people, Googling gold. And this is showing you that it's entering the psyche of investors in China again. This can be a very powerful layer to put on top of some of that central bank buying that we've seen. Let's move to the investment case. And I love this graphic because at the end of the day, gold has finite supply. I know on this call, certainly with people that are blockchain natives, people that love cryptocurrencies, they tell you Bitcoin's fantastic because its supply is limited. But people who love gold will tell you the same thing, is that gold supply is limited. And what you're looking at here is if you took all of the gold that has been mined ever in all time, and you had that in a cube above ground, and we're talking here the jewelry, we're talking about the bars and coins, central banks, other, the electronics, you took all of that gold and you put it into a single cube. Gold is very dense. So if you were to craft a sphere of gold that weighed a ton, it would be roughly slightly larger than a football. So it is a very dense cube, but that cube would only be 22 meters in dimension, a cube. And that's pretty small. That would fit in an Olympic-sized swimming pool. And if you look at that and you break that down, jewelry is almost half of that. Bars and coins around 22%. Central banks, even though they've been accumulating, I would have expected a lot higher. Central banks only coming through around 17%. This little piece here on the edge. And then you've got other at around 15%. The other point I want to land on before I show you the next graphic on this is that the reserves that mining companies, exploration companies have identified below the ground, if you include that, as well as unproven resources or resources that are maybe too deep to actually extract in an economically feasible way, if you totaled those up, it would still be less than all of the gold that's already been dug up, that's already out of the ground. And this tells you that most of our resources have been mined, and this contributing toward that finite gold supply story. Now let's visualize that. That's your 22. I didn't go and recreate this. I borrowed this from a group online because I actually just liked it. And it fits in an Olympic-sized swimming pool. Look at that. You can see the Ford F-150. I'm in North America. Those are very popular. Your local contractors, Ford, can actually park on the gold block. And there's that little sphere in front of Mo sitting on a couch outside his house. There's his golden football sitting outside there. That's actually worth, if you look at that, around $50 million, right? It weighs around 1 metric ton. This is all of the gold that has been mined in the world. And I think that's a very powerful graphic to kind of land on as we try and close off this investment case. What is the investment case? We've touched on so many points. The first is gold is a hedge against inflation and currency depreciation. Historically, it's preserved your purchasing power. A lot of people saying we should move back to a gold standard that we had prior to 1971. I don't know if we actually get there, but I do. I mean, we've got the US announcing a strategic crypto reserve, and again, maybe that's because they know they don't have the gold sitting in Fort Knox. But I think the more you see the pushback against gold there, the more you're seeing interest from other global central banks saying, yeah, we need to boost our resources. It's not saying we want to peg our currencies to gold, but we believe gold is a hedge against not just inflation and currency depreciation, but the next point, it's a safe haven asset in times of crisis. And I say crisis, that's singular. It's actually more like crises in this point in time, because we've got these geopolitical tensions all over the show, relative financial instability. We're not talking global financial crisis or COVID pandemic times, but there's a lot of uncertainty in the market. Gold performs well under those time periods, as well as time periods of financial instability, economic downturns. Then the portfolio diversification and low correlation. We've touched on that. Gold is not correlated as highly. In fact, it's barely correlated to equities. And that makes it an effective diversifier in portfolios. It means that you can actually boost your overall returns on a risk-adjusted basis in a portfolio by adding gold. Then the limited supply and intrinsic value, we've touched on that. I quite like that gold fitting in an Olympic swimming pool. That's because I really like gold. It's also a store of value with global demand. It's something that's fungible. It is in humanity's psyche because it goes back to such a period in history where it's internationally accepted. Central banks, institutional investors, retail buyers, worldwide, they're accumulating gold, and this reinforces its status as a globally recognized asset. It's not the only asset, but it is certainly one that warrants some sort of consideration in investors' portfolios. And then lastly, increasing accessibility. And this means that gold is no longer the preserve of ultra-wealthy people. I mean, at present, if you look at a Kruger Rand, and I can bring in the Mesh team shortly to talk about Kruger Rand, where that's trading. I remember buying a Kruger Rand way back when it was actually trading around 3, 4, maybe 5,000 Rand an ounce. We're now over 50,000 Rand an ounce, thereabouts, maybe 60,000 Rand an ounce for a Kruger Rand. And it has become the preserve of increasingly wealthy people, but not anymore, because you now actually have means to access gold in smaller increments. We'll get into some of that. It's no longer the preserve of just nation states and central banks buying it. They may actually be pushing the price higher, but there's also a narrative that is growing amongst retail investors. Remember that Baidu chart, China's Google, that chart of the interest in searches. That's coming through from retail investors that are interested in getting involved in gold. Certainly, I'm one that has been in the kind of gold bug space for the longest time. It's always represented a very strong core portion of my portfolio. I've been very happy with it. And what I do when it goes sideways, because yes, it went sideways for a very, very long time. Well, actually, I'm not that fussed, because when that's going sideways, it means the rest of my portfolio is probably going up. And vice versa, when the rest of the portfolio is coming down, I've got gold that's probably going up or preserving my value. That's the diversification argument that you get. And those are some of the points, not all, but some of the points that really build the investment case for gold. I'm able to kind of go to Q&A section here, and I think I'll hand back over to the Mesh team. For those of you that are interested in more insights, that's where you can find me. Reach out. I'm on X. I've also got a podcast. It's called Magic Markets. Go and check that out. We discuss all kinds of things on there. In fact, our most recent podcast was with the Mesh team on gold. It was so interesting. So go and check that one out as well. Louise, I hand back to you. Thank you.
Thanks, Mo. That was absolutely fantastic. Ladies and gentlemen, we've got a short time over, and I'm sure our panelists will be happy to stay on a little longer if any of the other questions need answering. We've got a couple of questions from the audience, which I'm going to relay. Connie, I think this one really talks to your wheelhouse. And there are actually two different questions, but I think that they are two sides of the same coin, excuse the pun. The first question is, can you explain how fractional ownership works with Troy Gold, and what does it mean for investors? And the other side is, what role does blockchain technology play in the tokenization of Krugerrands, and how does it ensure trust in the system?
Hey, I'm maybe going to have to ask you to repeat the second question, but to the first one, fractionalization is such a interesting topic. As Mo mentioned, what is starting to happen here is more and more retail clients are looking at investing in gold. So physical gold obviously comes in full quantity. So generally in a single coin, which is generally 1 ounce worth of gold. But not every one of us have the means to buy what is currently between 55 and 60,000 Rand worth of gold to keep under our mattress, or go store with Mo's coins in his, what is it, your couch, Mo, I believe. So if you want to invest in that, which is not in your wheelhouse to invest in whole numbers, you can then go on a fractionalized basis and buy smaller components of it. So in our primary market, you can go down as low as 50 Rand per investment. So that is just the minimum amount in the primary market. Louisa mentioned at the start of the webinar that there's a 2-week phase in which we would be running this discounted pricing. But thereafter, because of the power of tokenization, the power of fractionalization that comes with that, you can trade as low as the 7th decimal place as well. So that means that in the micros, even if you have that dust lying in your account, you can actually go and buy a component of gold every month when you invest.
I think that leads on to the second part of the question, which is really about the role blockchain technology plays in the tokenization, this world of tokenization. How do you use it to actually tokenize Krugerrands?
And when it comes to the marrying of the two, it's obviously the technology that enables us to do this. So whenever you see on different websites and places that you can actually purchase this at a lower amount, that means that you won't actually have a physical asset going to line your account, but rather a book entry. So we all know what happens when there is a financial crisis, or if you actually want to take your assets and go trade it somewhere else, and especially the retail market gets hit very strongly by this. What actually needs to happen then is you most probably are going to be forced to sell off that asset, take that money, and then go reinvest it. So if you come out of the world of tax, that should be giving you a cringe and a shiver. Because that means that there will be a taxable event happening at that time. So they're actually forcing you into a taxable event. But in this world of where we've now married the gold holding that is backed by this token we actually have achieved hyperfractionalization and ownership by bringing this technology to board in this way.
Great. And then, Rob, maybe a quick question to you. How does Mesh verify that if each fraction of the Kruger Rand represented by the Troy Gold token is legally compliant and fully backed by physical gold?
So there are two pathways to that verification. So if you own the 1 ounce coin, or you own a 1 ounce token that is backed 1-to-1 by a 1 ounce coin that is held in a vault, which is managed by an external third party from Troy and from Mesh, and that is then regularly audited and certificates are issued against it, and the coins inside that vault are also allocated serial numbers. Within the fractionalization portion, we have the ability to provide a fraction of that 1 ounce in a token environment, and we then are part of the audit process, and as a result, we can issue certificates of ownership or part ownership, so the smaller decimal places of the token, and we can prove that they're housed in the decentralized ledger on the blockchain against each individual investor's name. And those tokens then have a specific value aligned to the 1 ounce token, which is then backed by a 1 ounce Kruger Rand.
Perfect. So maybe a little question for you, Mo, because you touched on ETFs, and one of our audience is saying, can ETFs match the physical gold market? Is it possible?
I think that's a great question, because when you're looking at financial gold, usually what happens, whether it's an ETF or an ETN, for example, is that some of them are, you've got to pay attention, they're not necessarily backed 1-to-1. Sometimes there's the cost within the structure that kind of eats into the return. And I think that you're going to see that in a quirk in terms of any financialized gold format, right? Is that the costs that you're going to have to factor into it are insurance and storage. I think that's going to be the case with regards to these tokens as well. And again, I'll push that back onto the team from Mesh to maybe answer that. But as a result, over time, you might see this as a divergence between the spot price of gold versus the performance of the financial asset. That being said, if you were actually taking physical delivery of the gold, whether that's in your couch, we joke about this, the couch is the preferred storage place in South Africa, where you put your valuables. Whether you're storing that in your couch or whether you're storing that in your mattress or in a vault somewhere, you're going to have costs associated with that. You're going to have insurance costs associated with that as well. And quite often, a lot of people who buy the Kruger Rands don't factor that cost into their psyche. So at the end of the day, they are actually pretty close. Not all of them are. Got to pay attention. What are you actually getting? Are you getting a 1-to-1? And I love this, because with Mesh, I'll tell you what really resonates for me. And this is it's not kind of a shill for Mesh, but what I really like is the fact that I can get physical delivery of the coin. So I can actually accumulate this over a period of time, those scraps or the dust, as Connie said, in my account, can allocate that to gold. And once it's enough to actually make up a real Kruger Rand, I can actually push that button and get Troy Gold to come and deliver that coin to me, so I can store it in my couch and then pay the storage and insurance.
I really want to be invited to your house, Mo. I just want to come inspect your couch.
You're not allowed to sit on the couch.
Can't be the most comfortable couch.
To my question, Connie, Robert, I don't know if you want to maybe address that point around the insurance, the storage.
Well, I'll get there. Maybe Connie wants to take it, or I'll take it. But the other part of the ETFs, which people don't really realize, the 1-to-1 is not always physical gold, and you have futures and derivatives and a whole bunch of other things in there that could derail your performance. And you're paying a portfolio management fee or some form of fee for the fund manager to run that ETF for you. So that also then erodes on both counts, the not always 1-to-1 of gold, and the additional cost of a portfolio manager further erodes that performance graph you were talking about. But getting to the cost of storage, I see there's, and I'm sure Louise has picked it up, but there was a question on fees and total fees. So the price that that investors are going to pay is a Kruger-Rand price that has all of the fees, margins, as you do from any other coin distributor, built into that pricing mechanism, and that's the quoted price that the investors will pay. The only additional cost to the clients is will, on the date that the coins are tokenized and distributed into each investor's account, we will levy or create or raise a fee that covers 2 years worth of vaulting, storage, and insurance. And that fee is 1.2%, and it's 24 months of the costs that you would have to pay to any other distributor and or vault provider at day one. And then in 2 years' time, we'll come and chat to you about how you want to pay for the next 2 years of costs to keep that gold coin safe and available for you should you have built up to 1 ounce token and you want to physically redeem it and store it in Mo's couch.
So, Rob, won't you just expand on that, just to talk about why this price, that this 2-week price is actually quite unique, and how we managed to achieve that for our investors?
Yes, you always know how to put me on the spot, and I've got to rack the deep abyss of my long-term memory of the journey of the price. But so what a lot of people don't realize is that the Kruger-Rand price is effectively the price of Kruger-Rands from the refinery, and that's the Kruger-Rand spot price. But that's just the cost to get it or buy it from the refinery. And there are a bunch of other costs involved, which are logistics, couriering, storage, and insurance on the way to the coin dealership. And then obviously the coin dealership will add their margin, because no one, they all need to eat like everyone. So they will add a margin onto the coin. And that's the price that you get quoted from a coin dealer. A registered coin dealer is inclusive of all of those costs. And that's why Kruger-Rands don't match the spot gold price exactly, because spot gold is the starting reference point. And then there are a number of other costs in the journey of the Kruger-Rand getting to you as part of your ownership that you have to add on to be able to then realize what the actual Kruger-Rand price is. So for this 2-week period, for the investors to mesh and the initial primary issuance in partnership with Troy Gold, Troy Gold with their partners have negotiated a discount to certain of those costs added on to the spot Kruger-Rand price. And for this limited time, investors are going to be able to get up to a 3%. We're hoping it'll be more on the subscription date, but we don't want to overcommit, but up to a 3% discount on the retail Kruger-Rand price being made available to the investors, which is pretty cool. And I would think quite a large attraction to be involved in the investment cycle of this issuance.
So I think Connie, you've explained what happens around tokenizing and buying a fraction of a Kruger-Rand. What happens if I've got the money to buy a whole Kruger-Rand? What do I do? How do I get that Kruger-Rand so I can put it in Mo's couch? Oh no, my couch.
Determining which couch I will leave up to you, and hopefully a cup of tea with Mo. But if you do have that money to come into this process, you're not just subscribed to Mesh just yet, go to www.mesh.trade, or you can also alternatively go to app.mesh.trade. Click on that sign up button. If you're already registered, click on the sign in button. So you go through a verification journey where we verify your identity. You know the drill. You do that with your bank. Usually you go get your ID book, you go get your proof of address, usually your electricity bill, and you upload that for us onto the system. We verify you, and you pay from your bank account over into your Mesh account, and you enter into the subscription in whatever amount you want to enter into. My recommendation generally is, while you're in your bank, we don't work hard here, we work smart, put up a debit order. So if you do want to pile up that couch money like Mo does, the best thing is to invest before you spend. So put up that debit order and run it monthly and buy it in the secondary market as well.
Perfect. Thank you, Connie. I think if you don't mind just wrapping for us, I think Mesh is really positioning itself at this intersection of traditional finance and blockchain technology. There's been a huge adoption, and maybe most something to do with what's happening in the sort of geopolitical environment. There's been an opening of the regulatory sort of arms to look at blockchain as a significant and a meaningful platform for managing secure, immutable and trusted financial transactions and the interaction of trade. Connie, I'd love you to have that last word on where the future is in terms of what investing in the future will look like.
It's such a wonderful question, Louisa, because it ties in so well with why would you invest in a tokenized gold asset if you're not serious about this world and where it's going to? Why would you do that? So looking at the marriage of this technology and marriage of a lot of the trends that we're seeing happening in the market, and not just talking about because I chose to build a company in this space, but really looking at what is the wider market doing? What is that adoption curve that we're seeing? And I quote someone that I hope many of you have heard of is Jamie Dimon. And he said that the future of this market, the future of the capital markets, in fact, is within blockchain. So if your company is not investing in that, so if you're a FSP, a wealth, a financial advisor, an institutional investor, and you don't have a plan to be in the blockchain space in some way or form, so whether that's with currency investments, using the technology, using the benefits that come from the wallet infrastructure, what are you doing if this is the future of that market? And the same thing, I would quote this for our retail investors. So if you're investing on your own behalf, I see we have questions around Bitcoin as well. How does Bitcoin compare to the safe haven aspect of gold? I hope there's a couple of people sitting up in their chairs, because I think that's a lovely topic for discussion and no argument. But you need to diversify your portfolio in this as well. Generally, we're seeing a 5 to 6% allocation being recommended currently for Rob's favorite word, model portfolios, to invest into crypto-driven assets as well. But cryptocurrencies are not crypto assets. So in the wider space, why is Mesh so unique here? And why is it that we're in this space and doing this lovely gold-backed asset? Is that we understand the difference between utilizing the technology, which is the blockchain technology, and what we now are starting to term the next level of capital markets. The combination of this is actually creating a capital market that is globally accessible and incredibly fast and incredibly accurate. So the assets that we're listing on our platform are not just cryptocurrencies and or stable coins. They are assets that are trading on tokenized format, but they are all assets that you find in the market. And we really love unique assets that you struggle to find somewhere else. So you will see things such as the Morse corporate bond on platform, still one of our all-time favorite assets traded by our investors. Now with the Troy Gold asset also coming through, we have some beautiful AMCs listed by our friends over at Anbro, but very unique assets that you struggle to find somewhere else. And we're not stopping here. We're just bringing more and more of them into the mix. So we actually open up the capital markets and we widen it and create more investment opportunities for everyone else. So come along on this journey with us. We hope to build it with you. And I'm excited to see how this Kruger-Rand-backed asset also brings along its little story in the journey as well.
Wonderful. Thank you, Connie. And thank you, everybody, for spending the time. An absolute master on his topic. We loved your presentation. We really appreciate it. If there are any questions, please do get in touch and let us know on www.mesh.trade. If you've got some questions for Mo, just send it to us and we'll make sure that he gets them and we'll respond to you. And this webinar will be available for you to share with friends, with colleagues after the fact. So thank you so much for spending time with us.
Thank you.
Thanks, everyone.
Okay, everyone.
Thank you. Bye.
Bye-bye.